Disclaimer. This video is for informational and educational purposes only. It is not financial advice, tax advice, or legal advice. Certain investors may use these strategies, but every situation is unique. Always consult with a licensed professional before making any financial decisions. Welcome to Real Estate Capital and Growth USA. Today, we explore a fascinating idea: zero-interest loans in U.S. real estate investing. Across the American market, this concept sparks curiosity, debate, and often misunderstanding. What does it really mean? How do investors discuss it? And why does it carry both opportunity and caution? Let's explore this step by step, starting with the history. Zero-interest loans in U.S. real estate investing often sound like the holy grail of property funding across the USA. From Los Angeles to Miami, investors picture an open vault of free money fueling every deal. But here is the truth: no traditional bank in New York, Texas, or anywhere else in the United States simply hands out capital without strings. Instead, what circulates in conversations are creative financing structures, where interest is temporarily reduced, offset, or cleverly redistributed. Some investors label these as zero interest, yet the reality is far more complex. The myth of free money has roots in marketing language and storytelling across the real estate industry. Phrases like no payments, no cost, zero interest are designed to capture attention. But when examined closely, many of these offers involve introductory periods or short-term promotional incentives, not permanent conditions. Certain investors discuss using high-limit business credit cards for Real Estate USA to cover renovations or short gaps, framing it as a zero-interest tactic. Yet beneath the surface, such methods depend on credit cycles, expiration dates, and repayment strategies. Reality becomes clearer when we analyze how these structures operate. Rather than being free, many setups involve deferrals or trade-offs. For instance, one strategy discussed by property investors in Texas and California is private moneylenders for real estate deals where returns are negotiated differently. Instead of monthly interest, the investor might share part of the project's gain. This changes how costs are distributed, but it does not erase them. The label zero interest can be misleading without understanding these mechanisms. Finally, there are hybrid cases where business loan for passive real estate income structures overlap with business credit score real estate investors. Strong credit profiles in the USA, particularly in states like New York and Florida, can unlock promotional funding frameworks where interest is absorbed differently. Here, the zero-interest label represents not a gift, but a reallocation of timing and responsibility. It is essential to stress, these are not universal options, but selective structures accessible under specific qualifications. In summary, the phrase zero-interest loans in U.S. real estate investing is more myth than reality when taken at face value. There is no fountain of endless free capital in the USA. Instead, what exists are creative, structured tools, powerful in context, but never without cost. Awareness of myth versus reality helps frame discussions without overpromising results. And remember, this is not financial advice. Always consult with a licensed professional before making decisions. The blueprint behind zero-interest loans in U.S. real estate investing in the United States is not about traditional banks handing out free capital. Instead, it is about alternative frameworks, where creativity replaces convention. Mechanisms like deferred repayment schedules, introductory zero-cost terms, or community-based investor pools are part of the design. Each concept has its logic, and each invites both opportunity and scrutiny. Now, let's dive deeper into how these blueprints are structured in theory, before we weigh their true potential. Creative mechanisms. Some investors in the USA describe these arrangements as zero-interest pathways, but what really happens is a reshaping of cost. For example, instead of interest, repayment may be delayed for an initial period, giving breathing room to explore opportunities. Another approach involves investor-to-investor funding circles, where returns are shared collectively rather than paid as direct interest. In practical terms, this represents a flexible real estate capital blueprint that is often discussed under themes like alternative property financing USA or creative loan structures real estate. Theoretical strengths. Theoretically, the strength of zero-interest loans in U.S. real estate investing lies in how costs are shifted, reduced, or distributed differently. Instead of accruing standard interest, some models emphasize value exchange, such as service, equity stakes, or phased returns. The blueprint is less about eliminating cost and more about redistributing it strategically. Phrases like real estate investing frameworks USA, equity sharing strategies, and alternative funding models are often used by analysts when describing these practices. Flexibility versus risk awareness. While the blueprint suggests adaptability, no strategy is without considerations. Some frameworks promise temporary relief but require careful negotiation later. For instance, a deferred payment model can look attractive at first but may create heavier obligations once terms mature. This is why many voices in the space emphasize that these systems should be studied as case studies rather than templates. Search trends in the USA show queries like real estate capital structures explained in non-traditional loan blueprints, highlighting strong audience interest in understanding the mechanics without mistaking them for guarantees. In summary, the blueprint of zero-interest loans in U.S. real estate investing in the United States is more about design than free capital. It is a map of alternatives, frameworks that delay, redistribute, or share costs. These models highlight the innovative side of real estate capital, but they also underline the need for caution, clarity, and professional guidance. Next, we'll look at how these theoretical strengths carry hidden weight, both appealing and challenging at the same time. Warning disclaimer: this is not financial advice. Talk to a professional. This video is for educational and informational purposes only. Zero-interest loans in U.S. real estate investing offer a clear duality in the USA. On one hand, the benefits can be compelling: early-stage cash flow relief, breathing space to develop projects, and the ability to manage multiple real estate deals simultaneously. Investors from Miami to New York often explore these structures as a theoretical advantage. But the allure comes with an equally important caution. Let's explore both sides of this double-edged sword. Upsides explored. The positive side of zero-interest loans in U.S. real estate investing lies in early operational flexibility. Certain investors use these structures to temporarily reduce financial pressure while renovating properties or expanding portfolios. In states like Texas and California, investors may integrate these strategies alongside business loan for passive real estate income or high-limit business credit cards for Real Estate USA. While not universally applicable, this flexibility allows for careful project pacing, making it attractive to those prioritizing operational efficiency over immediate gains. Risks examined. On the flip side, risks exist. Zero-interest periods may end abruptly, repayment frameworks may compress cash flow, or subtle fees can surface unexpectedly. Some investors in New York or Los Angeles find that without careful monitoring, these frameworks can create temporary relief but long-term pressure. Theoretical examples include private moneylenders for real estate deals adjusting terms after introductory periods, highlighting why awareness is crucial. Balancing perspective. Understanding the double-edged nature is essential for clarity. Investors analyzing business credit score real estate investors and diversified funding structures recognize that neither side is absolute. The real insight lies in viewing these tools as selective, context-dependent frameworks rather than universal solutions. Awareness, planning, and context sensitivity transform a potential pitfall into a strategic observation. In conclusion, the double-edged sword of zero-interest loans in U.S. real estate investing in the USA underscores both opportunity and caution. It is a mechanism offering breathing room and strategic flexibility, yet it demands contextual understanding. Awareness is the key takeaway. Appreciate the potential without overestimating guarantees. Next, we'll explore the critical mindset and qualifications investors often consider when evaluating these frameworks. Warning disclaimer: this is not financial advice. Talk to a professional. All content is educational and informational only. Zero-interest loans in U.S. real estate investing are not universally accessible. Only certain investors in the USA, from Miami to New York, may encounter these frameworks. Success often depends on strong business credit scores, credible track records, and carefully cultivated partnerships. It's not about chasing free capital, but understanding when and how these tools might fit into broader investment objectives. The right mindset matters more than any label. Let's explore what qualities, strategies, and awareness separate informed participation from mere hype. Investor profile. Not every investor can leverage zero-interest loans in U.S. real estate investing. Often, eligibility relies on strong business credit profiles, verified operational history, and established networks. For example, investors with excellent business credit score real estate investors metrics may gain access to flexible structures that are unavailable to newcomers. In cities like Miami or Los Angeles, selective frameworks are designed to reward diligence and prior achievements rather than purely capital-seeking behavior. Strategic mindset. Equally important is the mindset. Investors must approach these mechanisms with an analytical perspective, not a get-rich-quick expectation. One strategy involves pairing business loan for passive real estate income frameworks with careful project pacing, ensuring flexibility in cash flow management. Keywords like scalable real estate strategies USA and alternative funding analysis appear frequently in search trends, reflecting investor interest in measured, strategic approaches rather than impulsive decisions. Awareness and alignment. Finally, awareness of personal goals is crucial. The tool is only effective when aligned with broader strategies. Certain investors integrate private money lenders for real estate deals or high-limit credit cards in calculated sequences. Awareness, timing, and contextual understanding prevent overextension. Queries in the USA often involve terms like real estate funding alignment strategies and effective investment planning USA, underscoring the need for education and informed observation over assumption or hype. In conclusion, moving beyond the hype of zero-interest loans in U.S. real estate investing requires both qualifications and the right mindset. It's about strategy, diligence, and situational awareness rather than chasing free capital. Awareness, critical evaluation, and informed participation transform opportunity into potential insight. Next, we'll zoom out to see how macroeconomic forces influence these structures across the USA. Warning disclaimer: this is not financial advice. Talk to a professional. All content is educational and informational only. Zero-interest loans in U.S. real estate investing in the USA do not exist in isolation. Broader economic trends, interest rate fluctuations, and investor sentiment all influence how accessible and attractive these structures may be. In high-rate environments, interest in alternative strategies tends to rise. Conversely, in calmer markets, zero-interest tools may receive less attention. The concept persists, but its significance shifts with the macroeconomic landscape. Let's examine how market forces and trends shape these theoretical strategies. Interest rate influence. Interest rate environments in the USA heavily impact the theoretical appeal of zero-interest loans in U.S. real estate investing. In periods of rising rates, traditional financing becomes more expensive, encouraging investors to explore alternative structures. Certain investors in cities like New York and Miami may seek cash-out refinance strategies for rental income or HELOC options for landlords as temporary buffers. Some words like real estate financing alternatives USA and rental property funding strategies reflect strong search interest in understanding these macro effects. Investor sentiment and demand. Investor sentiment and market confidence are equally significant. When uncertainty increases, some investors explore private money lenders for real estate deals or real estate crowdfunding platforms in the USA as alternative pathways. Conversely, bullish markets can shift focus toward conventional methods. Understanding the interplay between sentiment, demand, and zero-interest strategies helps investors contextualize these frameworks rather than chasing trends blindly. Some words such as U.S. real estate investor behavior and alternative funding sentiment capture this attention. Timing and contextual awareness. Timing and context are critical. While zero-interest frameworks can offer theoretical flexibility, they gain or lose relevance depending on the macro environment. Certain investors in Los Angeles or Miami may sequence business credit for real estate and alternative structures to optimize operational flow, without assuming guaranteed outcomes. Awareness of timing, regional differences, and market cycles ensures these strategies are evaluated as informative case studies, not prescriptive solutions. In conclusion, the macroeconomic environment shapes the relevance and accessibility of zero-interest loans in U.S. real estate investing across the USA. Market conditions, investor sentiment, and timing all influence whether these theoretical frameworks gain attention or fade. Contextual awareness is key. Understanding the environment transforms curiosity into informed observation. Next, we'll move to final reflections and actionable awareness for viewers. Warning disclaimer: this is not financial advice. Talk to a professional. All content is educational and informational only. Zero-interest loans in U.S. real estate investing are not a magical shortcut, but rather a nuanced idea, layered with both intrigue and complexity. Awareness, not blind pursuit, is the key. For more explorations of strategies shaping the U.S. property market, subscribe to Real Estate Capital and Growth USA. That way, you won't miss our next video as we continue decoding real estate financing concepts across the country. Thank you for watching.